Hello and welcome to the Rules of Investing, brought to you by Livewire Markets. I'm your host, David Thornton. The past 2 decades have seen a lot of crises that have affected financial markets. The global financial crisis, the European sovereign debt crisis, COVID-19, and the Russo-Ukrainian war. The list goes on. Last month, Fidelity marked the 20-year anniversary of its Australian Equities Fund. The fund has consistently outperformed its benchmark, the ASX 200 Accumulation Index, netting over 11% per annum. Paul Taylor, Head of Investments at Fidelity International, has captained that ship from inception till now. In today's episode, Paul explains his process for finding what he terms the holy grail of investing, long-term compounders. He also discusses the market's next buying window, the need to view stocks and their upside potential within the context of portfolio construction, and the next thing to break if rates keep rising. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to get notified whenever we post new content. Not a subscriber yet? Head over to livewiremarkets.com. It's free to sign up and you'll get access to the leading investment minds from Australia and abroad. Paul, thank you so much for joining us on the Rules of Investing.
Good morning. Great to be here.
Right, so the Australian Equities Fund recently turned 20. Congratulations. A lot of economic crises have dropped in that period of time, yet the fund's managed to return about 11% per annum over that time period. What's the most important thing you've taken away from the journey?
Yeah, I think that's a good point that you make, is that we've had in that 20 years probably about 8 or 9 different crises and some of them have been, very significant. The global financial crisis was 50% down. So I think the key thing, and as you said, through all of that, through some of the worst crises ever, the fund has delivered a little bit over 11% per year after all fees over that 20-year period. It sort of just tells you don't panic. It also says the equity markets are volatile; they go up and down, and you definitely shouldn't be thinking equity markets if you're thinking about a short-term investment. If you need your cash at the end of 12 months, equities are probably not the right place for you. But as a long-term generator of wealth, or my personal opinion is there's no better place to do it than the equity market. And that's also what those returns say. Through all of those different crises, you can still do 11% per year, but you've got to get rid of the noise. You've got to focus on what's important. You've got to focus on the long term. I think that's the other key thing, is that you don't get caught up in short-term noise and fads and fashions. You've got to focus on long-term fundamentals. And if you do that, the returns will be very good.
I mean, it's definitely noisy out there, noisiest it's been in a long time. How do you block out that noise? I speak to a lot of fund managers and they say they're investors for the long term. They don't really care about market movements day to day. Yet when I catch up with them, the first thing that they're talking about are the daily moves. How do you block out that noise?
Well, it's a very good point, and I think it's actually the art of the fund manager. So good fund managers can basically block out that noise. Don't get caught up in the day-to-day movements. Over the 20 years of the Fidelity Australian Equities Fund, I think our turnover is around about 15%. And so that tells you that we have an investment timeline, horizon of about 5 to 7 years. And I think that's about right. So that's what we're doing what we say we're going to do. And that 5 to 7 years, I think, is really important. It's the ability to look out that distance is important in trying to get rid of the noise. Now, some of the things that you do to filter out that noise is I always talk about, you want to focus on important versus unimportant. Now, that sounds very simple, but sometimes unimportant things are really interesting things. and you get sucked into those really interesting but unimportant things. So you got to ask each bit of information you get. You got to ask yourself: is it important or unimportant? You got to focus on the long term, not the short term. You got to be proactive, not reactive. That's what gets you into it. What I also find is my best days when I'm out meeting companies, talking to companies, understanding how they earn money, what's their business model, what's their strategy going forward. My worst days are when I'm sitting at my desk watching the market go up and down. And if you sit at your desk and see the screen go green or red, it's acting on you. And sometimes the best thing to do as a fund manager is to do nothing. But when a crisis is happening and the market's going down, it's actually hard not to, because everything's saying do something. When really you should be just evaluating. You should be spending time with the companies, not reacting. The market, it's an emotional roller coaster, and you do not want to get sucked in to that emotional roller coaster. So if you can, that's how you stay out of it. So how I do it is by not sitting and looking at my screen, but getting out and talking to companies. And that's the fundamental basis of our approach. And that's what we're all doing within the investment team. Or even if I'm at my desk reading or doing some research, I turn the screen off. Don't look at it. I also, on a news flow type, daily news flow, I tend to focus on things that are a little bit longer term. So I don't tend to read a lot of short term things. You get to the end of the week and you go, well, if information is there at the end of the week, it means it's got some longevity to it. So that's important. Or obviously if something's, happens in the mornings, people have forgotten about it in the afternoon. It's obviously not important and it's not relevant. I think the long-term, short-term thing is a really important thing as well. So you're continually asking yourself, is this something structural for the longer term? Because it's, like I said, in the short term you get fads, fashions, you get lucky, you get unlucky. Over the long term, it's what fundamentals will out over the long term. But they don't out, over 3 months, 6 months, even 12 months. Fundamentals don't necessarily out. So keeping that focus on the long term, keeping that focus on what's important, keeping that focus on being proactive rather than reacting to things. Simply by being proactive, you're saying this is what I think is important, and this is what I'm going to focus on. This is what I'm going to research as well.
I got to ask you about the GFC. Around Lehman week, Lehman's going under, markets were in free fall. Did you make any moves at all in response to that kind of event?
So I did make moves, but it was sort of in the lead. I guess I got ahead of it a little bit, but not a long way ahead of it, right? So one of the advantages I have working at Fidelity is that we've got one of the biggest equity teams around the world, and people think of Fidelity as an equity house, but we're actually a very big fixed income house as well. So in the lead up to the GFC was all about fixed income markets, commercial paper markets, and a lot of them were closing. So we were getting leads from our fixed income analysts, were basically getting that information out around the Fidelity Global network, effectively saying commercial paper market is closing, spreads are widening, and even then when they were widening, you couldn't necessarily, you couldn't do anything anyway. So then we basically go, okay, this is what's happening. This is the real world. Who's going to be implicated? And then it was a matter of in the local team saying, okay, who is going to be implicated in that? And just to give, an interesting example, it's sort of probably a bad news, good news story as well. So one of the IPOs we bought into the GFC was Rams Home Loans. Now, Rams Home Loans was right at the pointy end of what was happening in the GFC as well, because they were warehousing a lot of their loans. They needed the funding to get that done. Basically, the stock, when it opened from an IPO, it was weak at the start, but it wasn't too much. It wasn't too many problems. But it was coming off a little bit. So I think, just from memory, the IPO might have been around $2 or something like that. as we got the information from our fixed income analysts, as we started to understand the ramifications, we just, it was probably got to about $1.80. We decided to sell the entire position, which was relatively quickly after we'd bought into the IPO. Now, we lost money on that, but effectively Rams Home Loans went, effectively Westpac eventually bought it out, but it pretty much went to zero. So lost money, but it could have been a lot worse. And actually, that's exactly how our network and the analysts around the world, equity and fixed income, helped us get ahead of the GFC.
Has your view of markets or approach to investing in markets changed or evolved at all over that time period, or has the same recipe worked throughout?
I think it's always evolving. So if I just think about the crises, those sort of 8 or 9 crises over the 20 years, I think you do learn a little bit each time. And they are, obviously there's no substitute to experience, and the only way to get experience is to go through those different events. So I've learned a little bit as I've gone through all those different events. I think, it's Mark Twain quote that gets used quite a lot, which is that history doesn't repeat, but it does rhyme. And I think that's sort of what we take from a lot of these crises as well, is that there's a certain rhythm to them, and there's certain things that you can work out, and certain things. So right at the start of any crisis, it's typically based on, it's a very much a judgment call. And the only way you can make that judgment call is based on your experience. As you go through it, if you just take COVID-19 as an example, right at the start, we had a little bit of information because we'd been through SARS before, but it was really a judgment call, and that judgment call was based on experience. So you had to have that experience to be able to make the judgment call. But then as it went on and on, we got more and more data. You get more and more data. You can make a better and better decision as you move forward as well. So there's a lot of similarities. I think I've also probably got better at things as you work out exactly what you need to do. I think investment theory is actually quite easy. We sort of all know what we have to do. It's actually the execution that's very difficult. You know that when you need to be stepping in and buying things, or when you need to be selling stocks, but it's actually the execution that's quite difficult. I think over the years, just with the experience, I probably just got a little bit better at the execution. You've had more and more times where you've seen it come through, so you just get a little bit better at the execution side. But like I said, investment theory is actually quite simple, just very hard to execute on. And as you said, if you find yourself in the GFC or COVID-19's hit and the world feels like it's panicking around you, it's pretty hard to step. It is actually pretty hard to step in and buy things when you know that's exactly what you should be doing. It is still very, very difficult to do that. But the more times you go through it, the more experience you get in that. I'd say it's never got super easy, but it's got easier through time.
So if history doesn't repeat, but it rhymes, what rhymes are you hearing the loudest right now?
Oh, look, I think. So when I say some of those, first of all, when I made that comment about the rhymes, it was really around, like I said, it was more big picture. Like I was thinking, what is, what can we, that judgment call up front, right? So that you sort of need to know that you need to go through judgments. Now, the judgment call on the different crises for me is normally around this. What markets focus on very early is second derivative. So now that second derivative, it's like the acceleration or deceleration and everything. You take that back to COVID, it was the acceleration or deceleration. The second derivative was really around cases and infections, and it was almost to the day that infections peaked that markets bottomed. Now, that's just part of it, right? Because you really don't know at that point. That's a pure judgment call that's just based on the second derivative movements, but markets still bottomed exactly at that time. But like I said, the more and more data that you get, that you start to understand it and put a bit of a structure around it, that's effectively what you look. That's what you learn from. That's what you look at. If you think about today, I guess the big movements are inflation and interest rates. So people take their playbook from the 1970s. So now, so that's I guess if you're looking at the rhythm, that's the rhythm of what happened, back in the 1970s but they're trying to learn from that as well. Obviously, one of the things the central bankers always say is that probably the reaction through the 70s wasn't, if they had the time again, they'd do it slightly differently. They would have got on top of inflation much more quickly. That's obviously what the central bankers are trying to do now. So you've got a rhythm there, which is inflation coming through, but a slightly different version because the central bankers are now trying to get onto it much more quickly so that we don't get a pervasive period of high inflation, which can be quite negative, for a prolonged period. So that's the sort of slight variation.
So what will the most important second order effects of the rate cycle be?
Well, second order effects in any of those sort of things will be, with the rate cycle, it's really the consumer is at the forefront, right? They're at the coalface. So, and what I think they're trying to work out from the cycle, and that's the thing we don't really know. And even the central bankers are taking a pause just to see what it looks like. Is effectively how there's a lot of debt. If you look at the debt, in Australia, if I focus on Australia, federal government doesn't, its debt's increased through time, but it's still very reasonable by global standards. Corporate balance sheets are in incredibly good shape. Really, the debt is with mums and dads, it's with the consumer. And so as interest rates have gone up, there's sort of still a question mark of, well, how will people readjust? And then the other thing we've got is that a lot of them locked in lower loans that are now just starting to roll off, and this period we're in now is the sort of the peak period of those as the loans reset. So what we don't really know is how much that could impact the consumer, and that has obviously raised question marks or concerns around, well, will Australia go into a recession? So I think at the moment the base case is that we don't head into recession, but growth is definitely going to slow as we go through the second half of the calendar year. But that will be, for people to make the call. So this is probably more the call. The more the call is, well, when do you step into that? And that's where the second derivative will come in. So effectively, consumer spending, retail spending, it won't necessarily be that when it's slowing. It'll be when the slowness starts to decelerate, if that makes sense. So it'll be the second derivative, because that just basically tells you that we're coming closer to the end of things, and markets look 1 to 2 years ahead anyway. So they're really trying to work out, well, how close is the bottom coming here? So that on the second derivative, it will be when you step in on the consumer stocks. I definitely don't think it's now. We got a bit to go. Like I said, we've still got concerns, and there's still a possibility that we head into recession in the second half of the year. But we'll be continually watching when all of that has come out of the retail market, out of the consumer market, and that will be through a second derivative.
What's your best guess for that opportunity time frame? Is it confession season? Is it earnings season? When do you think those retail stocks will reflect the downgrades? You talk about things being slightly different. It's been probably the longest and most telegraphed slowdown ever. And the consumer really hasn't done anything. You go back through Christmas, the people are still spending okay, interest rates are going up. I saw someone say the consumer hasn't yet got the memo. And I thought, oh, that's exactly right. The consumer hasn't. Now, things seem to have changed in about May. So May, June, July, it's definitely turning over. So I think there's still a little bit to go. I do think there'll definitely be the best case scenario is a slowdown. We could head into recession. If we do head into recession, I guess my view would still be that it's a fairly shallow. It's not a deep recession. So you are
looking to step into those. I think it will be somewhere in the second half, probably later in the year than early. So it would definitely be post-August reporting season. So we'd be looking at August reporting season, see what the companies say, see what the trends that are coming out of that reporting season. It's, best guess maybe later in the year, but it's one of those things you got to continually stay on top of. You got to be, looking at the data continually.
So the consumer's at the coalface, and that means retail stocks are in the crosshairs. If inflation remains sticky and rates continue to go up or are at least held at an elevated level for a while, what's the next thing to break beyond the consumer and retail stocks?
Well, so that's a good point that you make, because that's, I think, the right way to describe it as well. So what we saw with Silicon Valley Bank, Signature Bank, and maybe to a lesser degree, but sort of Credit Suisse as well. So effectively, the first thing you see is a higher interest rate start to break business models. And that's exact. So, Silicon Valley Bank, Signature Bank, they had...
Well, they were full of bonds.
They were making bad decisions. The management team really should be kept, But what the business model they were setting up was an unsustainable business model. And so that effectively higher interest... That's what you see with higher interest rate. That's the other, quote I love is the Warren Buffett quote. It says, you don't know who's swimming naked until the tide goes out. So that's what happened. The tide went out and we just saw who's swimming naked. And you see, and as interest rates go up or stay there, you start to see who has the unsustainable business models. So retail is at the crosshairs because that's just, the more obvious one. There's talk about, whether commercial real estate or private market assets get impacted as if interest rates stay up there. Private equity is always looked at as at least an element of financial engineering within that. So there's the higher interest rates create issues for anyone that's trying to look at financial engineering. I think that's definitely the case, and that's what we did see through elements of that through the global financial crisis as well. So once again, I don't think you can ever get too far ahead on these things. You just got to be continually meeting with the market, looking at the data, seeing where there's cracks in business models. Because that, I think you're right. That's the next leg, which is you do see cracks in business models or where business models break because they've been dependent upon funding at low cost.
Does your mindset shift to capital preservation mode, or do you just trust the process and keep going?
Well, so I'm always thinking about capital preservation regardless of the environment, and I do spend a lot of time looking at sort of upside downside on different stocks as well. My best, for bigger parts of the portfolio or foundations within the portfolio, I'm really looking for something that's similar to a call option payoff, which is very limited downside, but a lot of upside should things go your way. Should a few things happen, you get a lot of upside. Now, to me, that's a really good stock payoff because even if those things don't happen, I don't think I'm going to lose too much money because the stock's looking very well valued, very attractively valued. It's a good quality company. We think they're heading in the right direction. So you're going to earn an okay return even if things don't go your way. But if this company's able to deliver on 1, 2, 3, we think there's a lot of upside. So that's really. So I'm in building the portfolio. They're the sort of stocks I think that are the foundation. So a lot of that is preservation, and I guess right at the moment as well. As we talked about, at least a slowdown in the second half and potentially a recession in the second half. I guess if I look at the portfolio, it's a little bit more, defensive in nature, where we're focused on a lot more of the essentials. The supermarkets, healthcare, which we think will do very well. Inflation, in fact, if anything, inflation helps them. So we talk about consumer that's going to be weak. If consumer's wallet's got $100 in the wallet, maybe the essentials, supermarkets and healthcare used to be 50. They're probably now 60 of the 100. The other bit that was discretionary we've had this bit of move between goods and services. So through COVID, it was all about discretionary goods. We all bought loads of stuff online through COVID. Now people want to get back out and do experiences, travel, hotels, flying, experiences. So they're taking up a bigger and bigger share. So that the discretionary goods is really the bit that's getting squeezed. So the portfolio is still, I'd say, positioned for positive returns because of the environment, but probably a little bit. I'd still say a little bit more defensively positioned.
This really goes to the idea that you can't pick stocks just in isolation. Like a portfolio isn't just a bunch of isolated calls. You have to make those calls within the context of the portfolio. Can you just expand on how you think about upside and downside of an individual stock and how that reconciles with the overall aim of the portfolio?
Yeah, definitely, and I think that's a really important point as well. So if you look at the Fidelity Australian Equities Fund, we normally have between 30 and 50 stocks in the fund, which we think is quite important as well. If you're below 30, it's probably not a diversified portfolio, but if you go above 50, you probably start to get too close to the market. So we think 30 to 50 is the sweet spot. And we definitely look at them within the context of one another. So the example I gave of that call option payoff, where you have limited downside but good upside if things go right, they're the foundation building blocks of the portfolio, because you can have so I can look at bigger positions in those sort of companies. But you might also get companies that have a lot of upside, but they've also got a lot of downside. So if a company's trading at $1 and you think it could go to $5, it potentially also could go to zero. Now, that's still probably a good trade-off, because you got 5 times or 500% or minus 100%, so that your net returns 200%. And that's probably worth investing, but that's never going to be a big position. You might allocate a small position to that, or if you have a few of those, you'll allocate a little bit to each of those companies, which ensures that maybe you get unlucky with a couple, lucky with a couple, and you actually get the return across the portfolio, which is actually the really important thing. So in building that portfolio of 30 to 50 stocks, you get those foundational elements that have not a lot of downside but really good upside if things go right. But you've also got a few of those smaller allocations to companies that might have a lot of upside but probably are a little bit riskier as well.
Yeah, that's fascinating. It sounds almost like diversification is more a game of diversifying upside and downside as opposed to just diversifying positions.
Well, you definitely think about the upside and downside as you go through that. Obviously I don't want downside. I don't want upside, but that's not always. There is a trade-off, I guess, maybe in each of those. So, like I said, my best trade-off is no downside and quite a lot of upside. But sometimes you do have to, if you're getting really, really high levels of upside, you probably do have to, the basic rule, there's a few rules of finance. More risk, more return means more risk, which is the starting point as well.
So the fund's really on the hunt for long-term compounders. How do you find them?
They are, long-term compounders are the holy grail, because, what we're fundamentally looking for is a high return on invested capital business that can reinvest at that high rate. So I often describe them as sort of beating the fade, really. So if you've got a company that's doing a 20% return on invested capital, that's well above market average of, say, about 7%. So normally through time, through competition or for whatever reason or new technologies, high return should come back, should fade towards that 7%. So you're really looking for a company that can just hang in there for a little bit longer, just beat the fade. And the longer they can beat that fade, the more sustainable their advantage, the greater the value creation. Now, if I give a few examples of really good compounders for, over that whole 20-year period. We bought, as in a great example, we bought JB Hi-Fi at IPO. Now, that was a great investment. And when we looked at it, we went down to the store economics. We looked at the return on the individual store. And then JB Hi-Fi had their strategic plan to roll out stores across Australia. And when we looked at it, we thought there was a very long runway, not an infinite runway, but a long runway of where they could sustain that higher return for a prolonged period as they rolled out their stores around Australia. And that worked incredibly well for us. But that it still needs a really good management team to execute on that. You still need the same trends that are moving, the management team to execute on it, for it to continue. So you can't just invest and forget about it. You've got to be on top of it all the time and think, well, actually, when are we coming? What's the valuation look like? When are we coming to the end of this sort of structural, higher returns? Will it eventually fade to the 7%? Because in all likelihood, it will eventually fade to 7%. It's just really beating the fade. And some of our other compounders like Seek, we bought Seek at IPO as well. That was about a $2 investment. Seek's obviously been a fantastic company for us over that period. WiseTech's been another great compounder. Domino's we also bought at IPO, which was $2, and it's around $50 now. So they've all been high return businesses that you can reinvest at that higher rate. And I think it's a couple of different things in terms of finding them. It's actually finding a sort of a business model that can be replicated. Domino's through their store rollout, JB Hi-Fi through their store rollout, Seek through the economics of that virtual model, of the network model. WiseTech through growth in e-commerce and the ability to continue to maintain their number one position. You want the business model. How can they maintain the business model? How can they retain the returns? Can they keep those higher returns going forward? And that's really just about spending time with the management team, understanding the structure, understanding the competitors, suppliers, distributors, the forces, the industry forces, and then really putting that all together and then assessing, well, how long can they keep this higher rate? How long will it take for it to fade back to a long run average? And if you can beat that fade, that will create a lot of value. And that's what we've seen, with companies like that over time.
I've got to ask you, Paul, what do you make of the secular tech rally we've seen?
Well, I think people are, you're right. There's been this sort of bifurcation of the market where you've got, tech world versus Main Street. And I guess the whole the technology side of it is really, productivity improvements and what's happening in AI and automation is quite exciting. Now, I'm sure as we go through that similar to, if I go back to, once again, I talked about the different crises and crashes and, as you've learned it. If you go back to 2000, so in 2001, we had the tech wreck. From probably 95 to 2001, we had huge growth in a lot of tech stocks. Now, a few of those stocks have gone on to become $3 billion businesses. If you go back to the late 90s, Apple and that, they're now $3 billion businesses. So there's a few businesses, I'm sure today there's going to be a few of those tech businesses that are going to be phenomenal as we move forward. But what the tech wreck showed is that there's a lot of disruptors, there's a lot of challenges, there's a lot of new ideas, and maybe of the 10 new ideas, maybe a couple come through. And there's a lot of people get left behind in that, and that's either they don't have the capital to continue to grow, or because a lot of the businesses don't necessarily throw off profits now anyway. So I think to me the tech situation will be the same now. You're going to, as we go forward, I'm sure there's going to be a couple that are just incredibly well positioned, but then a lot that will be left. on the sidewalk. So it will be all about individual stock selection.
Yeah, it's interesting to note that a lot of the tech companies that lead the market today didn't even participate in the tech wreck. They came afterwards, which really goes to your point about letting the dust settle, and then it's what comes next that's important.
Yeah, I think so. I mean, it's once again, if you think about, I guess what was it, MySpace, that was the original sort of social network, and it went nowhere, and it was really Facebook that's come through that process. So there'll be shifts and changes and movements, but I'm sure some of the companies that are here today will be very successful, going forward as well. I think also. Just trying to remember, there's an effect called the Lindy effect, which actually references longevity of something. So the longer something's been around, the longer it will likely continue into the future. The less time something's been around, it doesn't have that same. It might not have that same longevity. So once a technology is established and developed and has been around for a while, and we've got some obviously very large tech companies that have now proved themselves over a prolonged period, the better the chances that they'll continue to head in that same direction.
We'll move on to our 3 favourite questions, which we always finish with. Question 1, what's one thing investors are getting wrong about today's market?
I think it's really one of the interesting things right at the moment is there's just a lot of things to worry about, and people, I'd say more broadly, people are more negative on markets than positive. I would say that's sort of the consensus at the moment. But the funny thing is markets keep going up. So that, I think that's a positive sign all by itself, that people are, there's a lot of cash on the sidelines, so people are putting money into the market when they have to. But I think the other thing is you've got to realise when everything sounds great, it's probably not a good time to invest. So you're investing at a really bullish, excited time, and when you look at the next, if you're investing for the next 10 years, probably your returns are not going to be as high because it's already a buoyant period. And I think sometimes people wait for everything to sound great before they invest, and I think you're probably not necessarily stacking the odds in your favour if you do that. If you think about the current environment, we've got a lot of extra risk from inflation, from interest rates, from recession, from taxation, from regulation, from geopolitical risk. All of those things, we've got war. There's a whole lot of things that are happening in the world that's adding risk, and that's been the volatility. And often I always think of when markets are quite volatile, it's really the markets basically saying, I'm finding it difficult to value it because there's so many different risks entering the system. But if you have the timeline, if you have the investment horizon, and you can look out the next 5, 7, 10 years, investing when all of these risks are getting valued into the market often presents the best long-term, you're going to be rewarded for that. So I think that's what people miss sometimes. Everybody's trying to time the exact bottom. It's very, very hard to do. I think people don't. It's very hard to time the exact bottom.
So in the long run, close enough really is good enough.
Yeah, look, I just think a lot. When I just look at it, I just think, well, a lot of risk is now priced into the market. If I go back a few years, not a lot of risk was priced into the market. Now I'm sitting here, there's a lot of risk priced into the market. So once again, whether that means it's going to be good next year or not, I think, anything can happen in 12 months. But I think that's really if you've got a 10-year horizon, it's really stacking the odds in your favour because you're investing at a time of risk, and that risk is getting priced into markets.
Question 2, could you share a story of a big win or a big loss you've had in your career? What happened and what did you take away from it?
we spend a lot of time trying to work out what's cyclical and what's structural. Ultimately, what we're looking for is something that's in cyclical decline but has got structural growth. Because so you can pick it up cheaply, but you've got good structural growth ahead. But where things went wrong for us was when we thought it was cyclical growth that we now think has turned into structural growth. But it's very seldom the case that happens. It typically always goes back to cyclical. So it was just getting that cyclical structural wrong. And then the other one's just balance sheet, which you've always got to be very focused on a balance sheet. So just getting caught out on the balance sheet. So we spend a lot of time really analysing, especially in difficult periods. You want to make sure your balance sheet is super strong. You want to make sure you understand the cyclical versus structural. But then it's all about picking the compounders. So if I come back to your original question, so one of those compounders that worked really well for us, a company called WiseTech. And WiseTech was an interesting one because we actually bought it pre-IPO. So that's not listed on the market. They're getting ready for an IPO, and we can invest in those companies basically up to a year pre-IPO. And that was a great opportunity for us to spend time with the company, spend time with the management team in a private setting before it actually IPO'd, and get to follow it and get to understand the business. And that worked really well. And then it listed, WiseTech listed at about $4 just from memory, and it's just under $80 today. So, it's had obviously a very strong run. And then we bought in pre-IPO, so it was even less than $4 when we actually bought in. But it was a really interesting one for us because it was one of the few tech stocks. I think we're getting more tech stocks that list in Australia. But the Australian market hasn't really got that experience or background in analysing and following tech stocks. So the local market, markets tend to be a bit herdish. Everybody loves something or everybody hates something or somewhere in between. But there was a real negativity towards it because it was a tech stock and we didn't have a lot in Australia. I don't think the market really was on top of how to analyse those. But being a global firm, we obviously could call on people from around the world that had a lot of experience in understanding technology, understanding valuations, understanding how it moves forward, and we're in a much better position to invest into that company pre-IPO, and have got to know it better through time as well, and it's obviously been fantastic for us. So you do also really want to look for a company that that's not loved by the market, but in fact you want to have a lot of negativity around it really to get the best returns out of an investment.
All right, question 3. If markets were to close tomorrow for 5 years and you could only own shares in one company, not that we recommend a one company portfolio, which company would that be and why?
Excellent. Well, I'm glad to hear you wouldn't recommend a one company portfolio. So I'm going to follow that advice, and actually not, even though a 3 company portfolio is probably not too much better, I'd probably put it down. I'm going to say 3 companies that we are interested in. They're the 3 biggest in the portfolio. Maybe explain why we think they're well positioned. I think when you're looking at any company, you should be thinking about it within your portfolio, and then also the size of that position should come back to the upside downside that you think is in that as well, right? So the 3 companies I'd highlight would be. I'll start with Suncorp. So Suncorp is an insurance and a bank assurance company. It's about 2/3 insurance, 1/3 bank. At the moment, they're trying to sell their bank, and that's still under ACCC approval. Their insurance business, which is 2/3, is doing very well. The insurance market actually is very, very strong at the moment. So, people often look at insurance as, well, there's been a lot of catastrophes, there's a lot of payouts, which is right. That's historically what's happened. But that also means that capital is very tight within the sector. And actually, for everybody, I'm sure, that has a home insurance policy or a car insurance, you would have seen your premiums go up quite substantially. So that just shows you the tightness in the market, the capital that's gone out of it. So once again, the cyclicality of those returns are going quite well, and the insurance sector is in a very good position at the moment. In fact, we quite like the whole insurance sector in Australia for that reason. Suncorp has always been a bit of a forgotten stock because of that bank assurance model. So they've always argued, well, the banks will be able to sell some of the insurance and the insurance will be able to sell some of the bank. But it's never really happened and no one really believes them, right? So now they've effectively come to the conclusion, well, actually we need to be focused on, we want the simplicity. Markets love simplicity, they hate complexity. And Suncorp has been complex, it's becoming simple. Suncorp sold its life insurance business, it sold its repairs business, it's selling its bank, and it's basically becoming a general insurance business. So very simple, high quality, and they have a very strong position within the insurance market. So that's a good company that's growing their earnings all on its own. So I talked about looking for companies that have that call option trade-off or payoff. And Suncorp's a great example because we don't think there's a lot of downside in Suncorp's, attractively valued, good dividend yield, strong balance sheet. And actually, if they are able to sell their bank, there'll be capital returns to shareholders as well. But importantly, more capital go into the insurance sector that they can really ensure that they're in a strong position. That is dependent on the ACCC approval or government approvals, but to us it makes sense to do that. And if they're able to get that through, we think there's a lot of upside. And we also think Suncorp will get valued. Suncorp's been always traded at a discount to the insurance peers because of that complexity. So we think that some of that discount will disappear once the complexity disappears. So Suncorp to us is a great. Suncorp's not a stock that's going to double or triple, but it's got, we think, limited downside, but pretty good upside over the next few years as well. Another similar stock to us would be Ramsay Healthcare. So Ramsay Healthcare went through a tough period during COVID-19. Obviously, private hospitals really stopped doing a lot of elective surgeries, and that's most people go to private healthcare for some sort of elective surgery rather than or discretionary type surgery. Then they can't be put off. So if something's wrong with your knee or you've got a longer term heart issue, doesn't have to be right now, but it has to be at some point. Those operations can't just disappear, but they can be delayed, and that's what we saw through COVID. So there was some of the delays there. Also, we've seen costs go up across the board. So with inflation, costs have gone up for a lot of consumables within the medical space. Nurses' wages have gone up through that period as well. So they've gone through a very tough period with COVID and also with inflation. But what we've seen is that because it's healthcare, they're able to put up their prices to reflect a lot of that inflation. We're going through that process now. But probably more importantly than all of that, this is a rare infrastructure asset. Hospitals are a rare infrastructure asset. KKR made a bid for Ramsay, which we thought, sort of lowballed the valuation. Even that was way above the share price that we are today. But we think infrastructure investors will come back and look at someone like Ramsay, or a superannuation fund will come back and look at Ramsay because it's a great long-term revenue business, and they're always looking to match their long-term costs with long-term revenues. We think Ramsay is that rare infrastructure asset that can't be replaced. The hospitals around Australia, they can't be replaced. So once again, a stock that has got very limited downside but a lot of upside, through time. And the final one I'll bring into that is IGO. So the other big thing that's happening in the Australian market at the moment is this critical minerals, transition materials, right? So commodities have been in a pretty good space, but really the best place within that is the transition materials and the critical minerals. Now, everybody's focused on those areas. The demand for that space, so IGO is nickel, and lithium, or key ones are nickel and lithium, which are critical within electric vehicles and electric batteries. And we have to, it's taken us 200 years in our energy sources to get here, but we have to completely change in the next 15 years to move to, different energy sources. And it's actually, the interesting thing is we're going to be dependent upon the miners. So we've moved probably from we're going to be moving from fossil fuels to minerals. And the minerals are nickel, lithium, copper in that space. And IGO is one of the best, lowest cost, good production, high quality company. They're also going to be an employer of choice through this period. So there's less and less people going through mining school, less and less people going through geology. The ones that come through, they want to work with a company that's solving the world's problems, not one that's causing the world's problems. So, and that's all got to happen in the next 15 years. So it's going to be incredible, the growth, within this space. And I think IGO is one of the best companies positioned within that space. So if you look at those three, IGO, Ramsay Healthcare, Suncorp, we think they're all, incredibly well positioned for the next 5 years.
Paul, this has been an amazing chat. Thank you so much for coming on The Rules of Investing.
Great. Thank you so much.
I hope you enjoyed that episode. If you did, give it a like, and don't forget to subscribe to livewiremarkets.com for more free content like this. I'll see you next time.